Scott, it's great to have you back. We talked last week about giving some of your models a fresh look. It sounds like earnings growth is going to be one key dynamic here.
Well, yeah, it's still an area where, I think we can differentiate. Our view is that, yes, earnings expectations need to come down, particularly for 2023. But we also are of the view that relative to prior recession periods, we'll find that earnings prove more resilient than many fear.
So the idea of a severe recession still is a minimal probability in your model.
So this is the key question, right? So back in the springtime frame, when we were first putting out recession scenarios, we gave a more severe recession, a 5% probability. As events have unfolded over the past couple of weeks on the heels of higher interest rates and stronger dollar, you're starting to see some cracks, if you will. And so what we've done is lifted our severe recession scenario from a previous 5% up to something closer to 20%. Still think the base case is for a mild recession scenario, but we have to be more attentive in our view to sort of unintended consequences of the Fed policy actions.
Scott, that's still a big jump from 5 to 20%. Meantime, when you were on with us last, you did say that the market was primed for a rally here, and we seem to be getting it to start the month of October this morning. Your take right now in the near term and what you're watching as the next, I guess, key catalyst this week as we do see the S&P up 1.5%.
Right. So I'd say there are three areas that we're kind of focused on. The first, to your earlier commentary on the macro indicators, we are in a period right now where we think bad news is good in terms of the reflex on the fixed income side. And along that point, the second element of that is that we're watching the Fed funds futures curve very closely. And as it comes in or shows any signs of less hawkishness that had been priced in on the days following the last Fed rate hike, that implicitly is a positive in our view for valuations, which kind of sinks back to our move to go overweight tech a couple of weeks ago. The third part is longer term. What are we watching for here? And there's no question that the Fed is very clear on what it's focused on. And so in addition to the inflation indicators, we're watching other macro inputs, particularly on the wage side, to show some signs of relief that, again, would take a little bit of onus, not so much on the Fed rate trajectory, but on how high peak Fed rates might ultimately get.
So what would you be telling clients to do on a day like today?
Well, our view is pretty clear. Yes, we've lowered our year-end 22 target from 4,200 down to 4,000. The implication is that we think at some point during Q4, we're in for a relief rally. So on a tactical basis, we're going to play a pretty constructive tune here headed into Q3 earnings. Where I'm probably a little bit different than the previous speakers, that I do think that we'll see ongoing earnings resilience during the Q3 timeframe. But that's, again, in this context that we are very aware that there's probably room for 23 numbers to come down. But in a shorter term time frame, we think that Q3 earnings in aggregate will provide some form of relief around the the economic concerns that come with the rate policy.